Good morning and welcome to Zone Americas. I will share the session with Steve, who will give you an update on the Nestlé US growth model. So with 31 billion in sales, Zone Americas is the largest business unit for Nestlé and has something to do, obviously, with the sheer size of our US business footprint with Noosa and Pet Care North America in particular. But bear in mind that we got as well a tremendous footprint in LATAM, and even after the devaluation of the currencies in the last years, LATAM still accounts for a good third of the Zone Americas portfolio, more than 10 billion in sales. Pet care, contrary to the other zones where liquid and powdered beverages is number one category. Pet care, and we are very happy about that, is our number one category. The numbers that you see on powdered and liquid beverages are the 2018 numbers, so they do not reflect the impact of the Starbucks CPG acquisitions. Once fully integrated, Vision 2019, obviously coffee and beverages will be a very strong second pillar next to pet care. What is the environment? It is challenging. It is a competitive environment, obviously. And of course, the topic of the trade war impact is very timely and very topical. Impacts sentiment, but impacts as well input costs. We see a rise in aluminum prices, for instance, in the US. And this in a context where input costs have been adverse last year, will be adverse as well this year. On top, we got transportation costs on the rise, and this is a sheer product of the imbalance between supply and demand, so that's structural. We got the impact of the Latin American currencies, which have devalued significantly in the last years, record being the Argentinian peso. There is a translation impact, but there is as well a transactional impact, which is compounding the effect of input cost increases. The retail environment is evolving very fast, driven by technology and driven as well by empowered consumers, digitally empowered consumers. And last but not least, we got a pretty intense regulatory environment, especially in Latin America when it comes to nutritional labeling, and as well more globally, clearly plastic and recycling is high on the agenda. So clearly we want to accelerate growth, and we want to grow in that environment, and there are challenges, but there are opportunities. And the very first thing, of course, in the spirit of the Strategy Virtuous Circle, is to focus on achieving efficiencies. And we continue to have ambitious end-to-end efficiency plans. There is not one stone that will leave unturned across the value chain. And this brings 300 million savings annually. That will be the magnitude for 2019 and beyond. This is giving, obviously, room to invest, and we are at a time where there is a need to invest. In our case, we have been catching up with CapEx in the last 3 years, with 300 million additional CapEx being put on the table to support growth, and all those investments are now coming to fruition and will support growth going forward. But we want also to increase investments behind the brands. Innovation is critical. We have seen it in the first session. Innovation has to be incremental, is incremental, and of course requires incremental resources, especially as we want to continue to support the core. And of course, investing behind the brands, investing in innovation, investing to support growth, drives category growth, drives market share gains, which brings sustainable and profitable growth. And growth, as you know, of course, is one of the main levers of margin expansion and brings the sustainability into performance. We do that with people and teams at the core and with a vision to create share value for society at large, for our communities, for our people, and of course, for our shareholders. I'd like to highlight some of the efficiency plans that we have in the pipeline, so you can witness what we are doing when it comes to organizational agility and bringing on board new capabilities. We got this new head office in the US, more open, more connected, digitally enabled, and on the same model, we have moved recently our Brazilian operations to a new similar environment, modern environment, connected. We continue redesigning our pet care organization to make it even more agile, even more entrepreneurial. We are consolidating our media and programmatic capabilities in LATAM, and that will bring efficiencies. And I would like to highlight as well that Starbucks is being integrated flawlessly. And there is a second project that Nusa has executed with excellence. This is the divestment of US confectionery. Those are major projects. They have been executed flawlessly without disrupting the organization while it's been accelerating the growth. We keep focusing on costs in the spirit of efficiencies that a strategic virtuous circle. And one of the big news of the day is that we have decided to exit the company-owned direct store delivery network, which we got for frozen food in the US, supporting frozen pizza and ice cream. We communicated as we speak to the 4,000 people who are part of this organization. That explains the timing of the announcement, and we need to take care of those. Of course, they have been part and they are part of our success in the last years, but it's time now to evolve, and we believe that the businesses will be better served from the warehouse system which we got in place for the rest of the frozen business. Steve will give you more details on this transformation, which will have a significant impact on our business in the US. We have moved to one single IT organization in the US last year. We are moving this year to one single IT organization for Latin America. There will be efficiencies, but it's about effectiveness as well, building up new capabilities for the future, especially in the digital area. We have set up a shared service center in Paraguay for LATAM. This is up and running since September. Paraguay, because it's a good mix between cost efficiency, labor cost among the lowest in the region, but also a good source of talent. And last but not least, our industrial network review, Factory 2020, will be completed at the end of this year, so already in 2019 and ahead of plan. We do that, continue to focus on capital efficiency. The increase in CapEx has not penalized the ROIC. It's been improving, and we are contributing to the group development. Why? Because the CapEx have been well focused and are achieving fast returns, and we continue to focus on improving working capital. We see still opportunities to increase payables, and we believe that there is also some room for improvement in the inventories area. We put the focus, leveraging those efficiencies behind the growth categories, high growth, high margin categories, pet care, coffee, and infant nutrition. And I would like to highlight that in all three, we got R&D capabilities in the region, especially in the US, which we can leverage to bring speed and relevance in our innovation plans. Let me start with pet care, 8.8 billion of sales in the Americas. That's a real powerhouse. We are growing in North America. We are growing double digit in Latin America. E-commerce, which has been, of course, a priority in the last years, is booming, is growing 50% as we speak. And we have organized to leverage the natural and organic trends, not only on the ultra-premium brand, but as well across the core portfolio. Coffee, that's a big play, of course, for us. 4 billion in sales in 2018 in retail. If we include out-of-home, Nestlé Professional is 4.5, and once we have the full impact of the Starbucks integration, that will be 6 billion in sales. And of course, Starbucks is positioning us in the US market, which is the largest market in the world, but gives us also the opportunity and the capability to win in the second largest market in the world, which is Brazil. So leveraging the US part and making sure that it keeps the momentum while deploying in Latin America, which we are doing as we speak, will be absolutely critical to our growth and winning in the future, especially in the US and Brazil. We see opportunities to continue to premiumize and to leverage also the natural trend, both in soluble coffee, but as well in this powerhouse, which is Coffee Mate, and of course, out of home is a massive opportunity in the zone, both for Nescafé and for Starbucks. Infant nutrition, not as big as in Zone AOA, of course, but it's an important category for us. It's core, it's part of the essence. We want to keep winning, especially in Latin America, where we have very, very strong presence across the portfolio of options, meals and drinks, infant formula through premiumization, supplements in the spirit of the 1,000 days, and personalized consumer engagement is also of the essence. But we want as well to reinvent Gerber, especially in the US. As you can see, we are bringing back the iconic glass jar, but we're also leveraging the organic and natural trends. We are testing this Fresh Food Start new business model as we speak. We are also revamping our infant formula to align the offering with our best capabilities globally, and the internal expansion of the Gerber brand is a real growth opportunity. We see it in China, we see it in Asia, but we see it as well in Latin America. Of course, there is focus on the US frozen meals turnaround, and it's about improving the relevance of the core, recipes, product quality, formats. There again, there is not one stone that is left unturned, and we are really encouraged to see the business responding. And we want, of course, to expand the new platforms, and the plant-based platforms clearly is a significant opportunity for the short, medium, and long term. We have expanded our footprint in core categories. All those investments are now coming to fruition. We'll have more capacity to supply the wet pet food demand in North America, and we have been constrained for a while because of shortage of capacity, but we'll be capable also to support the development in Latin America. Pet litter is also an area where we are doing wonders, but where we are limited by capacity. We'll have more capacity coming on stream very, very shortly. We are building up a platform to develop super premium freeze-dried soluble coffee in LATAM, which we didn't have up to now. We are leveraging the Nestlé factory to develop infant formula in LATAM, but also we use the platform to supply Africa. And we'll use this investment for roast and ground coffee in Uruguay to supply RNG for the Southern Cone, including Starbucks in the near future. We are maximizing the mix through portfolio management. A lot has been happening in the zone, especially a lot has been happening in the US. I'd like to highlight as well the impact of Terra Fertil, where we see an opportunity with this Nature's Heart brand way beyond Latin America that has global breadth, that has global potential. And we are reviewing also the Brazilian portfolio as we speak, and especially in the non-added value dairy area, which is under review. We leverage the trends to innovate. Innovation is of the essence, of course, and it's about superior nutrition, life-changing nutrition, and we can impact the lives of pets, of course. We can impact the life of babies throughout the 1,000 days. It's about new health with organic and natural arguments, food intolerance, vegan and plant-based, local origin, especially for coffee, is a very powerful argument. And of course, we got the origin, access to the best origins. RTD, convenience is another opportunity. And premiumization, we see it across the board as a significant value creation opportunity for our core categories in the zone. We are developing new innovation models. We believe in the potential of open innovations, partnering with the ecosystem, startups. We got as well this internal incubator model, which has been very productive. We are testing new business model in chilled, for instance. We got with the loop system this circular subscription system, which we are testing as we speak. We are testing new vending models. We are testing as well personalization, personalized offerings in confectionery and in coffee. Of course, driving e-business is essential. E-commerce accounts for 1.1 billion in the zone. That's excluding Nespresso, and this is growing 50%. We are gaining share in the core categories, and we want to keep, of course, investing in this area, in the core categories, in the core platforms, pet care, nutrition, coffee, and in the core markets. And that's part of it, of course, but it is not the end of it. We believe that it's important to be strong in the consumer-facing part, personalizing the consumer experience, personalizing the communication, but it's important as well to connect the enterprise end-to-end, and our focus is at building an intelligent enterprise end-to-end connected to personalize the experience to the consumer, starting from procurement down to retail and distribution. Winning with people and teams is of the essence. That's the heart of the strategic virtuous circle. I'd like to highlight the progress we have been making in diversity, and I'd like to highlight as well the progress we are making in our journey towards zero accidents. We believe that it's possible to be efficient, it's possible to be effective, and it's possible to be safest in the industry. And of course, we want to do that while creating shared value for society as well as value for Nestlé. And the focus areas are around nutrition, Nestlé for healthier kids, youth, plastic, and environment. And as a video is better than a long speech, let me show you what are the key initiatives that we have in the pipeline in the zone. We can play the video, please. And momentum is back in the business. That's the big news and the big message. North America and Latin America both are accelerating, and the growth is coming both from volume mix and from pricing. Brazil is back to growth after a couple of years of decline in the context of economic recession. E-commerce is booming, and we got many areas of excellence, markets, categories, brand platforms where we are growing double digits, and we do that with improving returns. You see the development of the margins and as well the improvement in ROIC, which I've highlighted already, and the improvements in working capital. So, yeah, growth momentum is back and it's accelerating. Margin is on track to contribute to the group ambition or target by 2020, and we do that while reshaping the organization for the future, adding up new capabilities, investing in innovation, investing for the future, and improving the portfolio for the new reality. Thank you very much, and let me hand over to Steve, who will give you full details on the DSD project. Steve?
Thanks, Laurent. Anyway, as Laurent said, I'm Steve Presley, CEO for the US, and really a very focused conversation today around enabling profitable growth on our pizza and ice cream business. But before I start that, I just want to, quick refresher on the US. It's $28 billion of sales for the market, 30% of the overall Nestle group. And you saw in maybe Cagney or some other previous presentations, the growth returned in 2018. We didn't just talk about, we did it in the US, and the momentum continued in Q1. So good Q1 performance overall for the business in the market. And from a margin standpoint, we're in line with the overall kind of 2020 guidance for our business. So it's really focused around accelerating growth in this market. And so we look at how we change the underlying performance of the business in the US. It's really around just fundamentally transforming everything we do here. And it's focusing on growth. It's absolutely everything we do is around accelerating growth in this marketplace. And there's a bunch of different levers, but the two that I'll talk about are building the capabilities that are required to win in the future in this organization, across from whether it's digital transformation or artificial intelligence in the way we sort and hire people, to flexible manufacturing, whatever those capabilities are that you've heard kind of throughout the day. It's about building and embedding those in the way we do business every day. And then the second piece that's just as important, if not more important, to our ability to accelerate our growth in this market is actually our people and our culture. I believe fundamentally that we win in this market because our people are better and more passionate and more committed to this company than our competitors' people are. And we do that with pride, and we try to build a culture that allows them to succeed and thrive. And so we're really focused on those levers, and if we do those well, we know we'll continue to accelerate our growth in the market. But really what I'm focused to talk about today with you is we've made the decision to move our pizza and ice cream business from our company-owned DSD assets to our warehouse model that we use for our frozen meals business. And for mostly, I think you guys know, but direct store delivery today, we have a frozen model that delivers our pizza and ice cream direct to store from our warehouses, and we'll move it into our network. Now, it's a win-win for both us and our retail partners, so that's great. It enables key reinvestment behind these businesses that we haven't been able to unlock because of the route to market. And it really optimizes an existing best-in-class frozen network. So I'll go a little deeper. When you look at it, look, our frozen DSD is a highly complex and extremely costly operation. It's 4,000 employees, 230 different warehouse facilities around the country, over 1,400 trucks. We have 2,000 routes, over 3 million deliveries annually. So a very complex organization. It's an incredibly high cost to serve our businesses, and in these categories, it's just not sustainable. And so as we move, if you look, we get the question a lot, well, why in the past were you DSD, and as you think forward, why is it not part of the future? And for us, there were some historical benefits that DSD had that just no longer exist for a variety of reasons. Whether it was, okay, did you get improved performance on the shelf, or incremental displays, or do you get better channel reach up and down the street, or increased speed to shelf? All those things were kind of the old perception of what you got in terms of benefits from DSD. And the reality today is, as the retail environment's consolidated and the retailers have become more sophisticated in terms of controlling their space, they have really gotten very tight around planograms, and so there's no incremental space for display. And the one unique thing for frozen that maybe some of the ambient DSD people don't have to deal with, you need a freezer for a display, and so you can't just build displays around the store, and so it's very hard to gain some of these advantages in the space. And ultimately, when you look at our company-owned network, it's from our warehouse to big box retailer today. And so if you look at the total value chain across ourselves and our retail partners, it's a duplicative supply chain, right? We both have assets that go from warehouse to store and take that business, and so we can no longer have that in the total value chain between us and our retail partners. And we have a perfect analog. We have a very big frozen warehouse business, and we have a frozen DSD business, and we don't see material differences in the performance on shelf of a warehouse delivery model versus DSD for these. So it's really driven us to this decision. And for us, it's around simplifying our business model. If you focus on the left, today, we really have four core route to markets. Our frozen DSD that we're talking about today, our frozen warehouse that we take our meals business through, our chilled warehouses, which is about a $3 billion business for us today, which is Coffee Mate, Cookie Dough, some of our other businesses that go through that, and then our ambient warehouse, or traditional ambient warehouse. And we'll move from the 4 systems to 3, and we'll leverage our existing frozen warehouse system. So the complexity of that transition is actually fairly straightforward. We've already got an existing network that we'll plug into. We'll add some capacity to that, and we'll have a very large, efficient network that we go to from frozen. So we'll simplify the business from 4 route to markets to 3, and we'll move over our pizza and ice cream businesses into this. And I want to stress, look, it's a win-win for both us and our retail partners. There's improved margin out of this for both Nestle and for our retail partners in migrating these total value chain share. It's a far less capital intensive model if you move away from DSD. And ultimately for us, if you go back to what are the priorities in the market, it's about returning the market to a growth and accelerating growth. This is one of the levers we have to take to drive growth in this market, and unlocks the resources. Both of these categories are highly responsive to investment from demand generation standpoint. And so this unlocks some of those, and it simplifies the business ultimately. So when you look, it clearly has financial implications. The warehouse model is a lower cost to serve model, so you'll see trade operating margin improvement across the P&L. It will have a one-time sales impact. There's about a $450 million reduction in sales when you adjust the business models. Not all of that is organic growth, and you'll see from Francois later that it doesn't change the overall group guidance. He'll address that later, but you'll see kind of a step change to the new business model that won't really overall affect the guidance. And it does come with roughly $500 million of restructuring costs. And really it's around the assets and most importantly, the people. We don't take this decision lightly. We took it very, very seriously. And in the end, like always with Nestle, we will treat our employees with the utmost respect and care and concern as we exit out of this business model, and we'll invest to make sure we do that well. And so the execution is across really 2019. We started in the beginning of this year in discussions with our retail partners, working through the transition plan with them. And now we start the final transition planning for the next Q2, and then we'll really go live Q3, where we start to do the flip from warehouse to, or from DSD to warehouse. And the reality is 2019 is a transition year. So think of this year, it'll take us that year to migrate from one model to the next. And then 2020 is really when you start to see the value capture in that year. And why are we doing this? Why, right? Why? This is a big, complex, challenging project that I think the market has proven, whether it's with headquarter relocation, divestitures, acquisitions, the ability to handle these complex projects, but it's to unlock growth. These are good growth businesses for us. Pizza's growing over 3%, ice cream has grown 3.5%. We've innovated very effectively on both of these businesses. We've got over 350 million of new item launches in the last 36 months. We know there's more growth here. We just need more investment to drive these. So they're attractive categories that will change this route to market and invest there. And just to close, look, it's really around how do we evolve our foundation to drive future growth. And if you remember, just the kind of 5 key things, right? We've got leading positions in these 2 categories, and we need to have the right route to market to make them successful. We already have a best-in-class frozen warehouse system that we're leveraging. It's not building a new network to do this. It's eliminating one, so simplifying the business. It is a win-win for us and our retail partners. It's really we're doing it to drive and accelerate growth in this market, and you'll see the transition as 19 and 2020 for the value capture. But most importantly, this is just one of the projects as we think about, we try to create an organization that absolutely has the mindset and the capability to continuously transform our business in every single facet, and this is just one of the projects that we do to do that. So that's it for this transition. I'll leave it at that, and then I'll open it up to Q&A for both Laurent and I on either subject. Thank you.
Well, thanks a lot. We have 20 minutes Q&A before going to lunch. Jonathan? Yeah, go ahead.
Thanks very much. So on the DSD exit, 2 questions. First, can we imply from your decision that there historically have been some trade-offs made between traditional frozen and pizza and ice cream that can now be put together, just as far as total frozen space? Because it would occur to me they're going to the same place, and you can change that conversation with retailers. And secondly, does having an inherently more agile network, you'll have less costs and a lower quantum of fixed costs, allow you to premiumize and maybe emphasize your DiGiorno's and Häagen-Dazs at the expense of some less premium offerings? Thanks.
Yeah, sure. I'll take the first part of the question. Really, you compete category by category, and it's not like we today go in and trade off frozen meal space for pizza space or snacking space. We believe you've got to win the war battle by battle, and each battle is category by category. So we really focus on driving the right SKU and the right assortment at that category level. So that really hasn't been going on. I'd say the trade-off has been, there's been a shift in dynamic in terms of the retailer capability to handle this transition and move, so less about trade-offs within our own portfolio. And then the second thing is clearly a simplified, more agile structure on our ability to serve our customers is required and necessary. And not only does it allow us to kind of premiumize, but it allows us to drive that investment and drive innovation faster into this market and on these categories. We've got great research capabilities in ice cream and pizza and attached to the businesses today, and we think we can use these new resources to accelerate that growth, not just in premiumization.
And on the last part of the question, it's clear that when you got a DSD network with significant fixed asset structure, you need to leverage that structure. So any volume is good to take. In the future, when we variabilize the distribution network, we can put the focus more on the super premium offerings and maybe, slowly divest some of the less premium offerings.
Thank you.
Hello, it's James Target from Berenberg. Two questions on the US. Could you give us some color on how your share momentum is between the channels, e-commerce, club, discounters, more traditional retailers? Give us an idea of where the pressures are or where you're outperforming. And I guess related to that, where you're seeing the biggest pressure from private label on the category basis as well. Thanks.
Okay, Steve.
Let me take it. Yeah, so actually, if you look across the last 12 months, our share has moved pretty materially favorable almost across every category. We have a few that we continue to struggle in, but there's a clear mix in terms of there's some retailers that are clearly winning in the segment, and we continue to invest and win with the winners, as Marco said, in other parts of the world, and drive growth in those categories. I think when you look at our total share basket on our food and beverage basket, it's actually positive in the last 52, and it's positive even more so in the year to date. Doesn't mean we don't have struggle points, clearly. I think, and then if you go to the e-commerce, we're actually accelerating our e-commerce growth. You saw with Laurent at 50% at the market level. We're gaining share in that channel. It's different category by category because e-commerce lends itself better to certain categories than other categories for us. But we're over-indexing in e-commerce. And when you look across the retailer landscape, I had a lot of conversations about discounters in the breaks. Look, they're growing, and we play a role with them. Their model's a little different in the U.S. in terms of how they're trying to come to market, but it hasn't been incredibly material for us. I think, when you look across the basket of retailers that are winning, we feel comfortably positioned with all the ones that are driving growth today across our portfolio.
Okay, next question. Towards the end, yeah. John.
Hi, John Ennis from Goldman. I had a question on the North American pet care business. That's the category where we've seen a number of premium new entrants, and I guess I just wanted to hear your thoughts on what makes you confident that you can protect or grow market share in that environment and fill the new capacity that you're building. Thanks.
So we have a session dedicated to pet care in the afternoon, but I can give you flavor. Actually, the categories in which we are building up capacities have been capacity constrained for a while. So we were just not capable to supply the demand. And it's not a nice position to be when you see the opportunity to be able to constrain the retailers, constrain the deliveries, and not be in a position to promote your brands. So we are unlocking capacity, and that was a global issue, by the way. That was not specific to North America in wet pet food because the potential is global. We are building up capacity in the US, and I'm confident that this will be occupied at a good level very rapidly. We have built up capacity in Latin America, and at the time when we were building up the first line in the León factory in Mexico, we are building up the second line because we saw the demand. We were supplying from the US. We saw the demand booming. And in pet litter, we have been also under constrained demand for a long period of time. We could have sold a lot more. So on those, we are absolutely confident that we will be able to leverage the capex. And LATAM is booming, growing double digit, and we are adding capacity where we see the potential to grow. So we are really, really confident that those will be leveraged and will help us accelerate the growth of the category and contribute to the global performance of pet care. And where clearly Zone Americas has a strong role to play next to Zone EMENA.
Thanks.
Next question from Alan.
Yeah, can I just clarify the sales impact from this reorganization? I get that there'll be an impact on the selling price because you're letting go some of the distribution to the retailer. But is there a volume impact as well? Because I thought one of the advantages of a DSD system was it was getting you not just to the big box retailers, but to convenience stores and mom and pop outlets up and down the street. Are you going to actually lose some volume as a result of this, or are we just looking at a price adjustment because the distribution has been taken over by the retailer?
Yeah, I mean, it's predominantly just a price adjustment. There is a small amount of volume as you change a little bit of assortment change that goes into it. But for us, it's important. We talked about company-owned DSD. Our company-owned DSD is what goes to big box retail. It actually doesn't go up and down the street today. So we use third-party DSD to do that today, and we'll continue to service those customers in that same way. So we don't expect a volume impact in the non-traditional mass channels from that, and so it's predominantly price because of that.
Great. Any more questions? Guillaume, yeah.
It's Guillaume Delmas from Bank of America. My first question is for Laurent. You mentioned at the beginning of your presentation that there was a heightened level of regulation in Latin America with more labeling, use of plastics. And I understand that in the short term, it's creating some headache and a short-term disruption. But would it be fair to look at it in the medium and long run as a key source of competitive advantages for you because it raises the barriers to entry for small local players, and it favors large multinationals with great R&D capacities and a strong sustainability agenda? And my second question is on that shift to the frozen warehouse model. You mentioned that it's going to generate additional benefit from a margin standpoint. How should we look at this in the context of the 2020 targets? Is it more fuel to put behind your brands, or could you exceed your initial 2020 targets? Thank you.
Okay, on the very first point, it's clear that challenges always contain opportunities, and you're absolutely right that Nestlé will be always within the framework, and compared to competitors that might, especially local ones, take at ease regulatory framework. The fact that it tightens is not necessarily a bad thing, and the fact that we adjusted very quickly and very well to the Ecuadorian first, they were the first to move, and then the Chilean model has created an experience that is shared now among all our operations, and we are ready to face Peru, we are ready to face potentially Mexico. We are contributing to the framing of the regulations. Obviously, our position, our credibility in each and every country of Latin America gives us the speaking opportunity and to be listened to. But we are absolutely well prepared for that new environment, and the level playing field that it creates actually is playing in our favor. So I fully agree with that point. The second one was related to the DSD impact. Yes, Steve was highlighting that this will give opportunity to put more fuel behind categories and brands which are responsive to investment. That's pizza, DiGiorno, and that's typically Häagen-Dazs, but that doesn't change the 2020 margin guidance. That's part of the 2020 guidance.
We still have a few minutes. David?
Hi, David Hayes from SocGen. Just two questions. Just on the DSD change, is it fair to say that taking those brands out of that own system makes them easier to sell to other parties? And then the second question was just on the US in terms of SNAP and these subsidized payments. What is the outlook for that, and what impact and what exposure have you got to changes in that over the next couple of years? Thank you.
I take the first one and I pass the second one to Steve.
Sure.
As was highlighted, we see this move as a significant value creation opportunity, and we want to capture that opportunity. That's the answer. And on the second one?
Yeah, I mean, SNAP continues to be a bit of a political football as it passes between administrations. But for us, you took the big step down a few years ago in terms of reduction of the subsidy. This one really has just been timing, where it's caused short-term noise a little bit in the top line as the subsidy payments were delayed across the shutdown. But for us, as we look across it, we have some businesses that over-index with SNAP households, and most of our businesses don't. So to be honest, our overall exposure is not extremely high on our predominant food and beverage business. It's very few of our brands that actually over-index there.
Next question from Selina. Did you have one?
Yeah, so I just also wanted to come back on the frozen food. The margin for the frozen pizza as well as ice cream, could you comment, is it below that of frozen food? And as you look into 2020, would it mean that we will be aligned, and that means aligned with the group average? So if you could comment on that. And second, in terms of US frozen food, I know there was a slide, but could you wrap up exactly on all the initiatives you are doing in order to sustainably improve competitiveness here?
Sure. You want me to?
Yeah.
So on the individual margin of the businesses, we don't really comment at that level in the market. And so, but it's clearly one, this change is around improving the foundational performance of those businesses so we can drive them for better growth in the future. But we don't really comment specifically on the margin structure on those. And for us on frozen food, look, it's a primary focus. If you look at the performance, and you really can't take, there's no such thing as frozen food. It's a segmentation of individual businesses. So you look at ice cream, we're growing over 3%. You look at pizza, we're growing over 3%. Hot Pockets is actually growing a growing share over 3%. Stouffer's, we've returned to growth in Q1. Still lots to do on Stouffer's. I don't want to give any indication that the fight is done on Stouffer's. We have a lot to do there. But good, strong performance and turnaround on that business. Where we still continue to struggle is on the diet segment on Lean Cuisine, right? So that portion of the business hasn't really responded to some of the changes. I think we're working very diligently right now to determine what the future of that business is. I think it will have to evolve to a different place to meet the consumer needs of today's dieters and healthy eaters that we're kind of stuck with today, that we've got to move and reposition that brand some to capture that growth. And so if you look across our total frozen portfolio, we actually have some really nice growth segments within that. We have some very big weak spots on predominantly on nutritional meals that we've got to address to fix. But overall, we're pleased with the momentum. And I'd say the best thing we've done in the last 12 months is really around speed of innovation, right? It's food. We want to make delicious tasting food and get it to the shelf as fast as possible. And we've changed the way we innovate, we change the way we work with our R&D partners. We're able to go from idea to launch in a matter of months to actually get it onto the shelf in a matter of months instead of a 1 to 2 year cycle like we were in the past. So really food is not hard. It's about delighting the consumer every day, and making sure we're doing that with our products is what we've really been focused on, and re-embracing just the absolute commitment we have to delighting the consumer.
There is one more question before I hand over to Mark. Warren at the end.
I'm going to ask a question on Brazil. I think in Q1, Brazil was up double digits organic sales growth. And given it's your fourth largest market, just interested to know what's driving that recovery. Is it market growth coming back? Is it market share gains? If you can maybe kind of outline what's underlying that and what your outlook for the country is for the rest of the year. Thank you.
Yeah, so the positive thing is that we got volume mix growth and pricing growth. So it's clear that after a period of decline in pricing is coming back on the back of the dairy business. But volumes are also well orientated. So we are playing efficiently in a market which is also resuming, which is recovering after years of decline, years of recession. So this is the very timely turnaround that market is back to growth, and we are back to growth in a market back to growth. So there is a market share component into the equation, obviously.
Thanks, Laurent and Steve. And as we close out this section on the zones, I just wanted to share 3 quick comments with you. One is, and I'm sure the presentations bore that out, I can't tell you how impressed I am with the zone leadership that we have in place today in all 3 zones, and also in those key markets that are part of these zones. And to use a good baseball term, we have the bases loaded here for success in the major markets going forward, and very pleased with the change that has happened and how it's really getting traction for us. Second thing is, on DSD, this is massive. Okay, so this is a major news item for today. I can tell you, I mean, when I think about some of the preparation that was building up to this day, Laurent and Steve and I and, a high-level team, we've been huddling since last summer and hashing out all the details, doing precision planning that goes into this announcement today and then into that transition period that Steve was referring to. This is not sort of one of these light, high-level decisions. This is something that goes deep down into the operations of the company, but it's massive in terms of the value it can generate, can translate into the margin and also the growth upside, as Steve has indicated and Laurent has indicated. So this is a big, big deal to us, and I think it's also that commitment of generating value through improved operations that are in tune with the changed times. The time has come to make that move, and I applaud Steve, I applaud the US leadership team for not shying away from this, because it would be easy to kind of kick the can down the road and kind of not face that change. But that change has happened in the marketplace, as he pointed out, and we take that opportunity and now make the best of it. And the third comment I would like to make specifically refers to Zone AMS. And I know some of the questions were focusing on the OG, and it's important for me to highlight one thing that we also highlighted in London, and that is, as you compare all three zones, of course, I mean, we're doing a wonderful job in all three of them, but because of the peculiar and specific situation that we have in Western Europe specifically, which is 60% of that zone, there is an unusually large share of legacy issues that we have to deal with that refer to Zone AMS. And we're doing this, in massive markets like Germany, France, the UK. I mean, these are among some of the largest markets we have, with lots of silo-style management for essentially 150 years, because we've been in this market for a long time. And now we're driving these cross-zone strategies here and avoid some of the duplication, avoid some of the inefficiencies that were built into that system. We're doing this in a low-growth environment, lots of pricing pressure, also lots of pressure, as you can imagine, from our employee representatives and union partners. And so this is not an easy environment. And the mix of issues that Marco has to deal with, when you think about legacy things you have to deal with as opposed to the pursuit of opportunity, he clearly has to deal with a much, much larger share of legacy issues, while basically then also positioning the business for the future. And I can't tell you how impressed I am with that balance. And finding that balance here is particularly tricky in Western Europe, between, on the one hand, addressing those in a fearless manner, just doing what needs to be done, really facing it and not shying away from it. And yet, on the other hand, positioning the business for the future, making sure that we're not missing out on future trends that give us this growth that ultimately also energizes that part of the organization, that geography. So, fantastic job, but it's important to me as you compare these presentations side by side to just keep that particular circumstance coming from Western Europe in mind. And I think under the circumstance, that 2% OG number that you've seen us produce very consistently, coupled with the ambition, of course, as soon as we can to do better with that, I think that is a very good result. So those are just three comments I wanted to make. Hope you enjoyed that section. Hope you enjoyed the morning, and then hope you also look forward to the lunch break and more of our products.